It's the second day of big bank earnings in the United States. Goldman and Morgan Stanley beat estimates. Bank of America, it was more of a mixed story. Let's break down the numbers. We're joined by Don Nesbitt, Senior Portfolio Manager at FM Investments. Don, great to see you. Thank you very much indeed for joining us.
Thanks for having me today, Andrew.
Before we get into the individual banks, what theme are you seeing so far in this stream of earnings reports?
I think you're seeing reports that were similar to what you saw in the first quarter, where everything seems to be okay. The banks as a whole are doing okay. The reactions are somewhat expected because you've had a big run up in a lot of these stocks over the last couple of weeks or month coming into this, and some of the less favorable reactions that you might see are just basically selling on the news.
Let's get into Goldman Sachs to kick off here. Their profit was up more than 20% year over year. There was a beat. Is this a stock you favor right now?
We don't own the stock simply because there are so many other stocks that we've chosen. The one thing that stood out to me about Goldman is that they've increased their dividend by about a third, which is very healthy increase. And, we like stocks that do increase their dividends because that's a sign from management that they are confident. The corollary to dividend increases are stock buybacks. And stock buybacks, one of our stocks today that reported PNC, the regional, reported some stock buybacks. That's a great news. We like the stock buybacks as well as dividends, but dividends have staying power because you have to keep that dividend up. The market will look very unfavorably if you cut dividends, whereas a stock buyback can be done randomly.
What about Morgan Stanley? They had a beat as well. Their profit was up 13%. Is this a stock you own?
Yes, it is. And not surprisingly, they've got a very strong presence in the wealth management community with the U.S. A lot of these U.S. indices hitting record highs. Equity markets are very buoyant. The fees are very profitable, and they're a beneficiary of that.
And sorry, did you say that Morgan Stanley was one of your holdings or one of your buys?
Yes, it is one of our holdings. We do not own Goldman Sachs.
Oh, okay. Sorry, with Goldman, is it just valuation, or you can't own everything, I suppose?
Exactly. And, we found some other relatively favorable stocks. The other thing is we run a yield sensitive strategy. Basically, stocks have to pay a dividend. We're going to have to look at this now that they've raised the dividend because it could be more competitive in that yield space.
The next idea, Bank of America, they had more of a mixed quarter. Profit was up only about 3%. What should investors bear in mind here?
Yeah, still not a bad report. I think another large bank. Its outlook was fairly good. It, like many of the other banks, have benefited from the results of the Fed stress testing, and that allows them to hopefully deploy more capital moving forward. However, given that, the flip side of it is, sure, they can make more loans, but is the loan market out there to be realized?
And finally, PNC Financial, that was a beat. Not as big as the other ones, but a substantial financial institution. What are the interesting things about PNC?
Yeah, it's been a strong grower. It's another well-managed bank. When you have periods of uncertainty, you want to own the JP Morgans, you want to own the PNCs. When you're in late cycle, somewhere near late cycle like we are with the economy, these banks are good names known. Now, having said that, I go back yesterday to JP Morgan, which did fantastic, but you saw some analysts actually change their recommendations to maybe a perform or even a sell, and that has to do with valuation. valuations. And as I mentioned, a lot of these banks have run up recently in anticipation of a favorable earnings report, which we've seen. And so it's not only how good the business is, but how you're valuing these things.
And the one theme that you and others are looking at is this divergence among consumers in the United States, with the lower income groups suffering, relatively speaking. What does that mean for the banks?
Well, again, it depends upon the banks. Some of the smaller regionals, depending on where they are in the country, may have more difficulty. JP Morgan, as we talked about, some of these larger banks, Citi and so forth, their customers usually are pretty solid income earners, so it's not as big of a problem. Really filters down into maybe some of the regionals and some of the banks with lower quality credit portfolios.
And just finally, you I think believe, or your shop thinks, there might be 2 interest rate cuts from the from the Federal Reserve this year. What does that mean for bank earnings? I mean, generally, are interest rate cuts good for big bank profits?
Well, that's also what the Fed's projected. So we don't like to stray too much from the experts, right? I think if you look at the futures markets, it's telling you a similar story. So yeah, maybe we get 2 cuts. The important thing is the shape of the yield curve. And, the Fed controls the front half. If they can cut that's a bull steepener. That's good for banks. But however, they don't control the back end, and that generally is the investment markets. If that steepens, it's a bear steepener, which is not good, not as good. Obviously, though, the banks benefit from a steepening yield curve, where they basically borrow cheap and lend out at a higher price.